At age 30, I had exactly $0 in savings. No investments, no assets, no plan. Just a paycheck that disappeared every single month, and the growing feeling that I was falling further behind, no matter how hard I worked. If that sounds familiar, this video is for you. Because today, I want to share the exact mental shift and the exact system that changed everything. Not theory, not textbook strategies, the real thing. What actually worked, what failed badly, and what I wish someone had told me at the very beginning. Welcome to Financial News Daily, your trusted source for global financial updates. Every Friday, we step away from the market noise and talk about something more important than any price chart: your relationship with money. Because here is what I have learned after years of studying markets, investing, and personal finance. The market does not determine whether you build wealth. You determine that. Before we get into strategy, let me tell you where I started. And I mean really started. I want to be completely honest with you today. Because most financial content starts with someone who already had a foundation: good education, stable income, supportive family. My starting point looked different. I understood money the way most people understand it. You earn it, you spend it, and at the end of the month, you hope there is something left. There rarely was. Every month followed the same pattern. Paycheck arrives, bills paid, some spending, nothing extreme, just normal life. And by week 3, the account is back near zero. Sound familiar? Here is what I did not understand then that I understand clearly now. I was not broke because I earned too little. I was broke because I had zero system for where money went. Every dollar that came in had no assignment, no purpose, no destination. It just flowed in and flowed right back out. Mark Russell, founder of Better Wallet, who built a community of 350,000 people from his own zero starting point, said it perfectly. Before your first investment, you need to know exactly where every dollar comes from and where every dollar goes every single month. That was the first lesson I had to learn the hard way. Let me save you years of pain by sharing the 5 mistakes I made at the beginning. Mistake 1: spending first, saving whatever was left. Most people save what is left after they spend. The wealthy save first, then spend what is left. This single reversal changed everything for me. The moment I automated 20% of every paycheck into a separate account before I could touch it, I stopped being broke. Not because I earned more, because the money had somewhere to go before I could spend it. Mistake 2: confusing looking wealthy with being wealthy. I spent years buying things that signaled financial success, while my bank account told the opposite story. The Millionaire Next Door, one of the most important personal finance books ever written, documented this precisely. Most self-made millionaires live modest lives. They drive ordinary cars. They live in average houses. They focus obsessively on saving, investing, and avoiding the appearance trap. Wealth is not what you show. Wealth is what you own minus what you owe. Mistake 3: waiting until I had enough to invest. I told myself for years, when I save $10,000, then I will start investing. That day never came, because the lifestyle always expanded to consume whatever I saved. The correct answer? Start with whatever you have. $50 a month in an index fund is infinitely better than $0 a month waiting for the perfect moment. Compound interest does not wait for your comfort level. It rewards the people who start first, not the ones who start big. Mistake 4: taking investment advice from people who had never invested. Friends, family, coworkers, everyone had an opinion about where to put money. Almost none of them had any actual track record. The day I stopped taking financial advice from people who were not financially free,
was the day my financial life started to improve. Mistake 5. Not understanding the difference between an asset and a liability. Robert Kiyosaki's core lesson from Rich Dad Poor Dad is still the most important financial concept I know. An asset puts money in your pocket. A liability takes money out. A rental property is an asset. A car is a liability. A dividend stock is an asset. An expensive watch is a liability. For years, I was accumulating liabilities and calling them investments. The moment I started channeling money exclusively into assets, the trajectory changed completely.
Here is the exact system. 5 steps, no fluff. Step 1. Know your gap. Income minus essential expenses. That number, however small, is your wealth-building capital. Start there, not somewhere bigger. Step 2. Emergency fund first. 3 months of expenses. High-yield savings account, 4 to 4.5%. Never touch it. Without this, one unexpected bill destroys everything you build. Build the fortress before the empire. Step 3. The 4-bucket system. Every paycheck split automatically. Safety bucket, 15%. High-yield savings, short-term bonds. Income bucket, 20%. Dividend stocks, REITs. Growth bucket, 25%. Gold ETFs, index funds, AI and defense sector ETFs. Living bucket, 40%. Everything else. Keyword, automatic. Set it up once, let it run. When money moves before you see it, you build wealth by default, not by willpower. Step 4, learn consistently. 1 finance book per month. 1 hour per week studying what you own. The Psychology of Money. Rich Dad Poor Dad. The Intelligent Investor. The investor who understands what they own never panic sells. Here is the exact system. 5 steps, no fluff. Step 1. Know your gap. Income minus essential expenses. That number, however small, is your wealth-building capital. Start there, not somewhere bigger. Step 2. Emergency fund first. 3 months of expenses. High-yield savings account, 4 to 4.5%. Never touch it. Without this, one unexpected bill destroys everything you build. Build the fortress before the empire. Step 3. The 4-bucket system. Every paycheck split automatically. Safety bucket, 15%. High-yield savings, short-term bonds. Income bucket, 20%. Dividend stocks, REITs. Growth bucket, 25%. Gold ETFs, index funds, AI and defense sector ETFs. Living bucket, 40%. Everything else. Keyword, automatic. Set it up once, let it run. When money moves before you see it, you build wealth by default, not by willpower. Step 4. Learn consistently. 1 finance book per month. 1 hour per week studying what you own. The Psychology of Money. Rich Dad Poor Dad. The Intelligent Investor. The investor who understands what they own never panic sells. Now, here is why this framework matters more in 2026 than at any other point in recent history. We are living through one of the most disruptive financial environments in decades. The Iran war has driven inflation to 3.8%. The Federal Reserve has frozen rates. AI is eliminating white-collar jobs at an accelerating pace. And most people are frozen, waiting for stability before they start building. Here is the truth. Stability is not coming back on the timeline most people expect. The people who waited for stability in 2008 before buying stocks missed the greatest bull market in history. The people who waited for stability in 2020 before buying gold missed a 250% rally. What separates financially successful people from those who struggle is not their starting point. It is their mindset.
The market does not determine whether you build wealth. Your daily decisions do. In 2026, with inflation at 3.8%, every dollar sitting idle in a standard savings account is losing purchasing power every single day. The urgency to start, or to start better, has never been higher. The four-bucket system works in any market environment. In a war economy, gold goes in bucket 3. In a stable economy, growth stocks go there. The buckets adapt. The discipline stays constant. That is the system. That is the blueprint.